So will the Oxfordshire property market crash in 2022? According to some newspapers and pundits, the property market boom could soon be over with the increasing interest rates and inflation. In my article today, I want to share the 3 fundamental economic reasons why things are different to the last property market crash, the insider's way to find out if there will be a property crash, and my 4 reasons why buy-to-let landlords are coming back into the Oxford rental market to protect their wealth and hedge against inflation. With inflation and the cost of living crisis, some say this could cause property values to drop by 15 to 20% in the next year. There can be no doubt that the current Oxfordshire property market is very interesting. Today, when I wrote this article, there are only 663 properties for sale in Oxford, and the long-term 15-year average is 950 to 1,000, meaning house prices have gone up considerably. And according to the Land Registry, Oxford property prices have increased by 10%, or about 43,000 in the last year. So, as Robert Kiyosaki says, the best way to predict the future is to actually look in the past. And I need to look at what caused the last property crash in 2008 and how that compares to today. So number 1, increase in interest rates. One reason mentioned as a possible cause of crash is the rise in the Bank of England's interest rates affecting homeowners' mortgages. Higher mortgage rates mean homeowners will have to pay a lot more on their mortgage payments, leaving less for the other household essentials. In 2007 and the 1989 property crash, many Oxfordshire people put their houses up for sale to downsize to try and reduce their mortgage payments. Yet the newspapers fail to mention that 79% of British people with a mortgage have it on a fixed interest rate at an average mortgage rate of 2.03%. Also, just under 19 out of 20, 93.2% of all UK's house purchases this year are fixed on their mortgage. So in the short to medium term, 2 to 5 years, most homeowners won't see a rise in mortgage payments for many years. Also, 28% of all UK house purchases were 100% cash, no mortgage. So of the 932,000 house purchases registered since February this year in the UK, 260,000 were bought without a mortgage. Yet some people say this will be a problem when all these homeowners come off their fixed rate. The mortgage lending rules changed in 2014, and every person taking out a mortgage would have been asked a qualification as to whether they could afford their mortgage payments at a mortgage rate of 5% to 6%. No pundit says the Bank of England interest rates will go above 2% with a worst case scenario of 3%. If the Bank of England did raise interest rates to 3%, homeowners would only be paying 4.5% to 5.5% on their mortgages, and thus well within the stress test range made at the time of their mortgage application. This means the probability of a mass sell-off to Oxfordshire properties or Oxford repossessions because of interest rates, both which cause house prices to drop, is much lower. So number 2, house price or salary ratio. Another reason being bandied around by some people for another house price crash is the ratio of average house prices compared to the actual average wage. The higher the ratio, the less affordable property is. So in 2000, the UK average house price to average salary ratio was 5.30. i.e. the average UK house was 5.3 times more than the average UK salary. At its peak just before the property crash in 2008, the ratio reached 8.64. The ratio is now 8.85, so some commentators are beginning to think we're in line for another house price crash. However, I completely disagree with them because mortgage rates are much lower today than in 2007. The average 5-year fixed rate mortgage in 2007 was 6.19%, just before the property crash. Today is 1.79%. So whilst the house price salary ratio is the same as the last property crash in 2008, mortgages today are proportionately 71% cheaper. Number 3, the bank's reckless lending. Another reason for a property crash in 2008 was the reckless lending practices in the run-up to the crash. The first example of reckless lending was self-certified mortgages. A self-certified mortgage is when the lender doesn't require proof of income. In 2007, 25% of new mortgages were self-certified. So when the economy got a little sticky in 2008, the people that didn't have the income they said they had to pay for their mortgages because they were self-certified promptly put their properties on the market. The bank's second aspect of reckless lending was how much they lent buyers to buy their homes. Today, banks want first-time buyers to have at least 10% deposit and ideally more. There are 95% mortgages available now, meaning the first-time buyer only requires a 5% deposit, yet they are pretty challenging to obtain. Back in 2005, 6 and 7, Northern Rock was allowing first-time buyers to borrow 125% of the value of their home, yet first-time buyers got 25% cash back on their mortgage. And in 2007, 9.5% of all mortgages were 95% and 6% of mortgages were 100% to 125%, meaning that nearly 1 in 6 mortgages taken out in 2007 had a 95% to 125% mortgage. When the value of a property goes below what is owed on the mortgage, this is called negative equity. A lot of Oxfordshire homeowners with negative equity, or were getting close to it in 2008, panicked because of the credit crunch and they immediately put their houses up for sale. To give you an idea of what happened last year regarding mortgage lending, only 2.4% of mortgages were 95% and 0.2% of mortgages were 100%. This is because the mortgage lending rules were tightened in 2014. So why did prices drop in 2008? Well, in a nutshell, a lot more Oxfordshire properties came onto the market at the same time in 2008, which absolutely flooded the property market with properties to sell. Meanwhile, mortgages became a lot harder to obtain because it was a credit crunch, so we had reduced demand for Oxfordshire property. Prices dropped when we have an oversupply and reduced demand for something, and Oxfordshire property prices fell between 16 and 20% depending on the property type between 2008 in January to May. So what were the number of properties for sale in Oxfordshire in the last housing market crash? So there are about 780 properties for sale on the market in the summer of 2007, just before it happened, whilst a year later, when the credit crunch hit, that had jumped to 1,798. This vast jump in supply and the reduction in demand caused Oxford prices to drop significantly. Compared with today, there are only 663 properties for sale in Oxford, whilst the long-term 15-year average is up to close to 1,000. So what's going to happen with the property market? In my opinion, the Oxfordshire house price explosion since we came out of lockdown has been caused by a shortage of homes for sale and increased demand from buyers. However, there are very early signs that the discrepancy of supply and demand for Oxfordshire properties is starting to ease. Yet this takes a while before it has any effect on the property market, so it'll be some time before it takes effect. This will mean buyer demand will ease off whilst the number of properties to buy increases. This gradually brings back the Oxfordshire property market in line with long-term levels rather than the housing market crash. My advice, keep an eye on the number of properties for sale in Oxfordshire at any one time and only start to worry if it goes beyond the long-term average mentioned before. But before I go, I also need to chat about what inflation and the cost of living will do to the property market. How will inflation and cost of living affect the property market also? So there is no doubt that cost of living increases will have a dampening effect on buyer demand. If people have less money, they won't be able to afford such high mortgages. This will slow down the price growth, especially with Oxfordshire first-time buyers. Yet the reduction in first-time buyers is being balanced out by an increase in buy-to-let landlords buying, especially at the lower end of the market. This in turn will stabilise the middle to upper end of the property market, and this means the values of such properties, mainly Oxford owner occupiers, will see greater stability and a buyer for their home should they wish to take the next step onto the property ladder. So why are more Oxfordshire landlords looking to extend their buy-to-let portfolios, even in these economic circumstances. So I see new and existing buy-to-let Oxfordshire landlords coming back into the market, add rental properties to their portfolios. And as the competition with first-time buyers is not so great, they're not being outbid as much. Yet more importantly, residential property is a good hedge against inflation. Firstly, in the medium term, property values tend to keep up with inflation. Secondly, inflation benefits both landlords and existing homeowners with the effect of inflation on mortgage debt. As Oxfordshire house prices rise over time, it reduces the loan to value percentage of your mortgage debt and increases your equity. When the landlord or homeowner comes to remortgage in the future, they will receive a lower interest rate. Thirdly, as the equity in your Oxfordshire property increases, your fixed rate mortgage payments, they stay exactly the same. And the inflation also helps Oxfordshire buy-to-let landlords. This is because rents tend to go up with inflation. So as rents go up, your fixed rate buy-to-let mortgage payments, they stay the same, creating the prospect of more significant profit from your buy-to-let investment. I hope this helps. This is Damion from Luxury Property Partners.